Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is the U.S. Mid-Session Brief. Today, we're talking commodities and really some wild action just about a half hour ago on WTI crude oil. We saw a major block order and a sweep lower. Really wiped out all the institutional longs, which is a real shame because the long side of this market, right from a key Fibonacci retracement levels, probably going to be a pretty darn good entry as we head into late week trade. But I will tell you right now, I don't like going for rides. I don't like taking big draws. Unfortunately, sometimes it's what's called an occupational hazard. Let's get right out to commodities and crude oil. You can see right here, this is the WTI crude oil contract for November. We've rolled to this. This is now the price of WTI crude. Ignore all the lines, but really pay attention to the Fibonacci's here because it's really a key area. It's one of those. It's a 3-week area that we need to understand is really robust downside support. If we do see the market break beneath this zone, the 69.50 zone, 69.42, then you're more than likely going to see a complete reversal in this market. It's difficult for me to say what exactly happened. I can tell you from my own play-by-play and my perspective, it's very rare that I get caught sleeping. Doesn't happen very often. I've been doing this for quite a while. I know the risks and the rewards, and this is what I call an occupational hazard. And if you're going to trade, you've got to understand what an occupational hazard is. Right here, came across the board at about 10:19 a.m. my time, about 12:19 p.m. Eastern. There was a major sweep, and this is a block order. This is a sweep, and this is something that we cannot account for. Unless you're on the inside, unless you're Goldman Sachs, unless you're JP Morgan, unless you're one of these big banks or you're a major investor, maybe you're Soros, maybe you're some of these folks that can really move markets, then maybe, just maybe, you'll know when an order like that hits the market. This one, I haven't seen anything like this in a long time, especially not attempting to nail me out of one of my trades. My entry point was right here. I was buying 69.73s. Everything looked pretty good. Nice, quiet markets. There was no real indication that you were going to get that massive spike of volume. So right there at 10:19 my time, we got this huge break. And I really want to break this down for you because this move happened so fast that my trading dome was not tracking it correctly. My trading view was not telling me what price the crude oil was trading at. It was happening that fast. And right here, take a look at what had happened. This is a 5-second chart. All right, this is a 5-second chart. I've got support right there. That's one of my range numbers right there at 72. I love that 75 area buy. I had another range number down there right around 50, 57. That was beautiful. And then my 38% that I just showed you was down there at 69.43. And what happened was we got swept right out of the box. Take a look at these volumes now. This is front month futures contract. This is what drives your U.S. oil market. I'm going to give you some levels for U.S. oil here after we cover the oil news today. But right there, what do we have? We have 3,000 contracts changed hands in 5 seconds. Another 1,000 changed in the next 5 seconds, and another 1,900 changed in the next 5 seconds. That type of action, that type of volume is the result of institutional block orders. So you always hear, okay, well, this is where the institutions get involved. This is, that's sort of one of the crux of smart money concepts, which is great when you see the swing highs and the swing lows develop. This right here is one of the most difficult things in all of trading to look at. So I want to break this down even further, and then we're going to move on to our analysis. We've got some key stuff going on in the precious metals market. We had a couple of trades that I thought were absolute bangers, at least for scalps, and they proved to be very well. This is a 1-second chart for WTI crude oil futures. 1 second. 1 second. 1,001. That's how fast. Take a look at what you got there. 1,200 contracts changed hands in 1 second. The next second, 987 in 1,001 and 1,002. That was 2,000 contracts. I can't explain to you without a news event how rare that is. That's very rare. So always remember that more than likely you're going to run into this situation as a trader. Now, if you were trading U.S. oil during that period, I guarantee the spreads went crazy, and you may have made a lot of money or you lost a lot of money. For me, I was looking to buy that support zone, all right, and it did work out for me. Why? Well, as bad as that initial heat was, it didn't last very long. And when trades don't last, and when moves don't last very long, or when you see a big, what I call a sweep lower, that's a big time sweep lower. right there, bam, that's a major move. That's when all the volume came in. Typically, you're going to get that retracement. Why? Because all that volume's on the sell side. There was no buyers. Typically, you see volume dry up in the buyer's end of the market. For me, I held my position, and I was fortunate I had enough money to do that. A lot of folks that trade retail just get jammed out. They get stopped out on something like that. I call that an occupational hazard. It means sooner or later you're going to run into it. I have to tell you that it's nerve-wracking. It gives me instant ulcers. So I try to stay the heck out of those as much as I possibly can, but I got paid on this one. It was fortunate. I'm not bragging. Believe me, I'm not bragging. When we're trading down here, when we're trading down at 69.22, I was in big trouble. You know, I was long from 73-ish. So I was rocking 2 contracts. So that was about $1,000 draw. The beauty of that was experience tells you that when it crashes that hard, just hold on to it. Wait a minute. It's going to get better. You've already taken the big draw. Things are going to get better in a minute. Just let it go, let it go. Now, immediately, once we got that initial bounce off of that low, I was very, very tight with my risk management from there on in. There's no way that I was going to lose $3,000 or $4,000 on this trade. Right here's the 1-minute chart, something like that. Bang. All right, right there, I waited, I sat, I said, okay, that's a pretty good retracement. Then we came off again, and then right there, once I saw my doji coming off those lows, I said, we got a pretty good shot here. We got a pretty good shot, and we did. We went right up there and took a few bucks of profit. My profit target was 38% on the 30-minute chart. So I made some money, but I will tell you that right there is a catastrophe. It's an occupational hazard, and no matter who you are or what you're trading, sooner or later, you're going to run into one of those. So that's why we talk about having your stops down. Even if you had a stop loss down in this situation, your slippage would have been huge. Remember, we typically use stop market orders as stop losses. You'd have lost a lot of money on your slippage. You would have got filled right down there at the bottom. Essentially, guys, this market could not find a buyer from the top up here. It could not find a buyer from 69.99 all the way to 69.25. That's a hard thing to deal with. Typically, those are account busters. I came out on the right side of it, but I guarantee you some traders got absolutely shredded on that. Was it your fault if you lost there? No. That's just part of doing business. You got to remember that anything can happen in these markets, and that's one reason why we talk about using proper leverage, and that's one reason why if you don't have any money to trade, get a prop account. Because if I was trading prop money there, I wouldn't even have cared. I'd have said, I'd probably still be holding the contract, thinking, yeah, we're going to rally up to 70, 25, something like that. But immediately when it's your own money and that cash register is going like that, that can be tough. So I want everybody to understand that's an occupational hazard. That can bury you quickly. I don't want those to bury anybody. Do the best you can to really stay out of those. And the number one way you can do that is to keep an eye on your key levels, but also keep an eye on your news events. This was just a sucker punch. A lot of people got knocked out. One of the reasons why is we traded beneath last week's low. So you saw sort of a plummet. A lot of stop losses got run, but the volumes were extraordinary. I haven't seen anything like that in quite some time. A 70-cent move, a 77-cent move in 2 minutes. You got to be kidding me. So, of course, we would all want to be short and take the money, but a lot of times those are just wildly unpredictable. Martin, good to see you. Martin, welcome. All right, guys, we do want to get started with commodities, and let's get right back out to price action. Gold is it. The metals markets right now. Matthew, good to see you. The metals markets right now are on absolute fire, and yesterday it was just bid. That's all I was recommending was the bid. And I can't give you financial guidance, and I won't give you, I won't tell you what to do with your money. I don't ever want to be affiliated with any of that because I'm not a financial advisor. I guess I could go back to school and become one. Personally, I'm schooled out. I've already done my schooling, and that's in front of the screen and in college all those years ago. But bidding any dip really in gold and silver right now is a great move. You can see right here we had a spike low. This 4-hour chart's been very, very good to us. Spike low there, nice spike high that developed sort of towards the end of yesterday's session, and then we pulled back. We hit that 38%, 26.52, and then 26.52, and the 26.52 again has been absolute money in the bank. Just be careful. Remember, the more times we hit that downside support level, the more chance we have of it giving way. And if this does give way, then we're going to see a sell-off down to 26.46, 26.41. If, in fact, that is the case, I want everybody to sort of be ready, be in position for the trade before it comes. Finally, we're getting a little bit of a pullback here on gold. Now, love my 4-hour charts with gold. When we're in a trending market, 4-hour charts are darn fine tools or instruments, instruments to use to trade, to get great location levels. Daily's better, weekly's better than that, monthly's better than that. For right this minute, we're in a trending market, so we've had to take our time frames way down there. And right now, I'm watching this daily relatively closely. We sort of got a little bit of a stutter step here, a little bit of compression. If we do get that sell-off, I mean, I'm waiting with bells on in the spot gold market just to get live right there at 26.25. That's a pretty darn good level, 26.25. Any reason to buy gold right now? And in fact, you're a buyback on any dip. It's going to be real hard to really mess us up there. So I'm looking at that as being a pretty darn good trade location, something that I definitely will be watching closely. Silver, let's get silver, and then we'll get on to the news of the day, and then we'll cover some of our other commodities. Silver is a beautiful thing as well. I outlined this trade yesterday as well. Sort of your spike low right down there. Boom, pullback was right around 31.50, something like that. That was a great trade. Your low right there was 31.56, and you got a good bounce right there. I'm still bullish, incredibly bullish gold and silver. I think the forward guidance that came out of the U.S. Federal Reserve last week was really something that we didn't really talk much about at the time, but we probably should have. They're calling for 2 more rate cuts this year and then a collection of rate cuts in 2025. So to me, I take a good look at this and I say, yeah, that compression's pretty good stuff, and we're going to look to bid, and bid some more for an absolute just banger trade location. You'd be doing something like that on a daily, 31.50, 31.53-ish. That's fantastic trade location. 38% pullback buy. If we get worse than that, 62% at 31.08, which is an interesting type of a dynamic. If we get that big of a pullback, do we go with more leverage or less leverage? Probably more leverage on that pullback. Is back into that golden zone. Really tough to argue with those. Let me see. All right, Matthew, we got a question coming in. Please explain why the U.S. dollar is going up when the Fed cut the rate. Well, I mean, the question really becomes, is it all just baked into the cake? Is it all baked into the cake? We talked a lot about what could happen to the U.S. dollar on the back end of such a historic rate cut. And when we looked at really what happened there, right there's your last Wednesday, you had a doji. Buyers didn't have control. Sellers didn't have control. We sort of got a nice peak there, and then a sell-off, and then a peak, and then a little bit of a sell-off, and now a big retracement. So I look at something like this, and I say, yeah, the question is going into that meeting and that rate cut, where the market's already pricing it. Now, remember, we've been pricing a rate cut pretty much most of this year. So the question becomes, as soon as we knew September was the day we were going to get rate cuts, that rate cut suggests a shift in monetary policy. So to me, the half a point really didn't do anything. I think it was more baked into the cake. It helped stocks for sure, but you're seeing a correction today in the equities markets. But as far as what did it do to the U.S. dollar? Nothing. It was already baked into the cake. We were up here back in April, May, June, just going, we wonder when we're going to cut. Are we going to cut? And then finally we decided in July we're going to cut. It's going to be in September. And I think that it was just priced into the equation. Will we go further south? Yeah. If we're going to cut another half of 50 basis points towards the end of this year, what does that mean? It means a quarter point in November. It means another quarter point in December. Yeah, you're going to see the U.S. dollar come off. But for right now, you're just seeing whipsaw action because that initial pricing mechanism where you said, oh, God, we cut a half a point, the dollar's dead. Well, people have known that. They've understood that for quite some time. So, it's already priced in. So it's the old deal where, you trade the rumor, not the headline. Well, I mean, you flip that around too. You trade the headline, not the rumor. For me, as soon as we understood with our CME Fed Watch that we were going to be cutting interest rates in September, that was a signal for people to start shorting the dollar, and that's exactly what happened. So for me, the actual news of Jay Powell coming out and cutting, even though it was a half a point, which was too big in my view, and it surprised a lot of us, yeah, that was a big market mover, but was it not expected? It was expected. So the U.S. dollar sold off a little bit. Now we're rallying. Will not shock me if we trade between 102 and 99 really until the next Fed meeting. But I also want to FOMC minutes are going to be big. That's coming up, I believe, next week or the week after. I mean, those are big. Those are big engagements because we're going to find out the dialogue in that room. We're going to see who's on board for big-time rate cuts and who isn't. And that's incredibly important, incredibly important. So to answer your question, Matthew, it was baked into the cake. Most of us knew they were going to cut. Personally, I didn't think we were cutting a half. But, when we did it really shock the markets? Not really. Sent some stocks, sent some bidders to stocks, but for how long? Markets adapt quickly. If I'm playing the DXY here, the dollar index, I'm coming right off of that low, right? 2023's low, which is right around 99.57 and 62% of that 2021 range, something like this. That's huge. Well, it's 2021 to 2022. That's a big time range. Pull back there. I'd love that level as a bid. So I don't think you're going to get any dollar, really serious dollar strength until we get down here. I don't expect the dollar really to rally much over the next couple of months. I don't expect it. Could it happen? Yeah. I mean, you saw what happened in crude oil today. That caught me off guard as well. So great question about the USD. All right, guys, if you need a place to trade, switchmarkets.com is the place. Check it out. 100% credit bonus. Show with $5,000 and you'll have twice that amount to trade. Can't beat that. You absolutely can't beat that. More money is the key. If you get your hands on as much money to trade as you possibly can, and if you do that, you'll be in business. All right, for today, we're talking new home sales. Interesting news cycle today. I won't really say that it was a great one. Just remember, pedal to the metal. We're trading our plan. We're seeing the trades. We're executing it, and we're trying to make money. That's the goal of today. Not every day that's the goal, but today that's the goal. News of the day. It was an interesting Wednesday. We had the NBA 30-year mortgage rates, which came in at 6.13%, beneath 6.15 last week. And also the NBA mortgage applications came in at 11%. And that's beneath 14.2%. So still back-to-back big-time increases in mortgage applications. Why? Because interest rates are falling. And when those lending rates fall, money floods into the market. And as money flies into the system, things like mortgages, you'll see cars. People will be out buying cars here pretty soon, trying to refinance their homes. I read that story earlier today, and that was absolutely they haven't seen refinancing stuff to the level that they've seen in a long, long time. So that was absolutely huge, really pivotal when it comes to really what the markets are doing. Right now, we're off today in our U.S. equities. We're going to cover a few of those towards the end of the stream after our commodities talk. But realistically, that's a strong signal that dovish policy is creeping into the system. And we're starting to see those lending rates ease up. You'll probably see your credit card rates probably start going down in the next 6 months. It won't be right away. Those will go down. But also, on the other end, if you're a saver and you're in CDs and things like that, full disclosure, I have some CD holdings. I'm probably going to have to liquidate them because those prime rates, those APRs that we're getting are going to come down. So, it's going to be one of those deals where I'm not necessarily too excited about the interest rate cuts. I think it's way too premature, but home buyers are, and those numbers sort of suggest that, okay, it's game on and everybody's flooding back into the real estate market. As far as what can we expect from our new home sales numbers, shouldn't shock anybody. We came in well above expectations, still down from the previous release, but why would we be still, above expectations? And it's because we saw more homes being bought than we thought. That's because of lending rates. Even though you're down 4.7%, I wouldn't put too much too much stock in that because we still beat expectations. Huge banner month in July for home sales. August, a little bit worse, but still really strong numbers. Specifically, considering where your prime rate is, and it's going much lower. I would expect that 30-year mortgage rate to be at 5% here relatively soon. So you need to be keeping a close eye on all this because it plays into, the relative strength of the U.S. dollar. As far as crude oil inventories, and that's sort of what we want to talk about today. Crude oil inventories came in at negative 4.471 million, and that's beneath expectations of 1.30 million. This is bad news for the crude oil bears. You typically, as you see these crude oil inventories fall, and as we see a decrease, typically you see price rise, and not necessarily today. You can see that we're off big, about 2.5%, but you typically see prices at least hold their ground and rise over time as you get a supply shortage type of a scenario. So, as we sort of, take a good look at this stuff, the number one way you read this is you go right there to EIA weekly petroleum data for the week ending September 20th, and you go right down to the third paragraph. The third paragraph is everything. Third paragraph is all I care about. It's all I'm reading. The rest of it, I'm not interested in distillate fuel imports. I'm not interested in refining. Here's what I'm interested in. The top line. Here's what I want to know. What exactly is oil inventory doing? Let's have a look. U.S. commercial crude oil inventories, excluding those in the SPR, decreased 4.5 million barrels from the previous week. At 413.0 million, U.S. crude oil inventories are about 5% below the 5-year average. There's no two ways about this. We're looking at a supply shortage. They have not, this entire year, we have not been able to build those supplies. It's a miracle that prices have stayed as low as they have for as long as they have, being still beneath that $70 threshold. So when we look at a report like this, the first thing I'm saying is, okay, what happened? Well, we came in big time negative. After Labor Day, that's trouble. We should start to see those supplies build, and it's not happening. Now, if in fact that becomes the trend going into the election and then after the election, you're going to see crude oil prices rise in a big way. A lot of that's going to depend on the election's result. What do you think the election's result would do to crude oil? I've said it a million times. A Harris victory is going to mean higher crude oil prices because of the sort of the desire to transition to the Green New Deal and the transition to greener energy, perceived greener energy. I'll argue all day long that electric vehicles are not greener than fossil fuels, but then again, I don't work in that industry, so that's sort of out of my lane. But what I will say is that transition is going to suggest that lower crude oil production, lower natural gas production is going to send things higher. Now, if you send things higher, where do prices go if we're running an oil shortage? We don't start creating any more oil, or at least the perception is that that's going to go down as we roll into the winter months. What if we hold $75 or $70 through the winter? It really does suggest big-time bullish crude oil. I've said it for the last 3 years, but it looks to me like this is going to be the catalyst the U.S. election will be. On the other hand, if Trump wins, we could see U.S. oil come way off, and I'll show you how right now. Actually put out a piece on Q4 oil expectations earlier today. If you haven't seen it, I believe it's posted on our Twitter. Check out our X account, HowToTrade at X. You can get in there and take a look at the piece. But I really am going to break down the technicals that I'm going to break down for you right here. So what did we have today aside from a major flood of volume right in there? That was a big one. I haven't seen anything like that in a while. But right now you're starting to see that full-blown trend develop. I don't think we're going much lower today, but I could be wrong. You definitely saw spike high, spike low, pullback, and now we're coming off. It really suggests that this is a full-blown intraday trend down, and our numbers tell us exactly that. We're down about 2.75%. But like I said, I mean, there's a major. I don't know about a supply zone, but maybe a demand zone coming into play. There's your weekly numbers. So we got a pretty good bounce off of that initial. My numbers are a little different than yours on the futures contract, but you'll see exactly what we're getting at. 69.69 was a pretty good zone. We broke beneath that level, and now we're coming down. Looks like we're going to extend these losses of this week. I would be looking to buy 68, 62% is an absolute fantastic entry point. You could take 68s and feel pretty good about scalping up and above that number. Now, big picture. What exactly can we expect from WTI crude in the near future? This is sort of the thesis of what I wrote earlier today on my Q4 crude oil outlook. Very important to understand exactly what all these price bars mean. This is a long time. I mean, this is a long time that's passed. This is a lot of data, a lot of trades, fortunes made and lost. COVID crazy low of April 20th, 2020. Now, or I think it was April 21st. Now, on this day, crude oil didn't trade at 1 cent. Okay, it traded at negative $40. Now, it's very important that we understand that. So the lower extreme of the COVID, really the COVID panic, was about negative $40. So if you go down there and you take a good look, and this number, just go ahead and Google. If you don't believe me, go ahead and Google oil lows April of 2020. And you'll get the articles. Yeah, crude oil traded negative. Why? Because all of the global stocks were at all-time highs. all of the storage was filled. It took money. You had to pay for somebody to store your oil. Now, the big guys could do that. The big producers, the Exxons, the BPs, all those guys, they could do that. They could say, well, we have our own storage facilities. We can also pay the premium to hold on to our oil until it goes positive again. And it didn't take long. You could see, even according to this chart, where'd you close the next month at? Where'd you close May at? $35. So still historically low, but it's a heck of a lot better, -40. So this market panic is really where the bottom of the crude oil market was. So I see a lot of people saying, well, Shane, 1 cent is sort of the bottom of this, and that's not true. This level right here is absolutely huge, and you need to understand that it's very, very important. That's robust downside support, $64, somewhere in there, $64.50. But take a good look at this. Your low back on, March of 2023, $64.41. What's your low right there? $63.61. And what's our low this month? Our low this month is $65.29. So bids from down there that level is going to catch some attention. $64, $64.50, you're going to catch a lot of bids there. So it's important to know where we're at right now, because we're not that far from it. We're only about $5 off of it. We're down, $2 today. We could test that level by the end of September, which is going to be by the end of the week. We rolled October's trade next week. So a lot going on right here with U.S. oil. I'm a bidder from down here. I think that the geopolitical situation and also our election situation probably is going to keep this market bullish. But if it does look like you're going to get a Trump victory, and maybe it looks like the Fed's not going to cut interest rates, be ready for a major, major plunge underneath 64.50 and 64. I would see this market going down. I won't say all the way to 44, because I think I would be very surprised if that happened quickly. But 55, 50, could absolutely happen going into the winter months. Idea being more production, and also if the Fed doesn't cut those interest rates, then we won't see commodities really extend their gains. They've been incredibly robust. All right, I did want to cover natural gas as well. Remember, if you're a natural gas trader, you contend with a lot. Natural gas is hard. I don't want to spoil any aspiring gas traders, your goals or your dreams or your optimism, I guess. But natural gas is a tricky market, and the reason why is because it's thin. You don't get the huge volumes that we see, saying even WTI is relatively thin compared to like E-mini S&P 500 or even your Forex pairs. So something like this, I take a good look at and I'd say, wow, 30-minute chart, sort of a nice big rally, and we're just trading sideways. You get that a lot out of natural gas. The market just won't really move, and then it'll all of a sudden move. You can see right there another great example of a sweep during yesterday's pre-market session. So I find it useful to focus on the macros, meaning the macro, sort of the macro market dynamic here of what exactly what exactly natural gas is likely to do. If you're going to do that, a couple events that you need to understand. Number one, Russian invasion of the Ukraine. It's probably the biggest market mover of natural gas in the past several years. I'm sure several options traders got absolutely cleaned out, while other option traders made millions of dollars. But right up there, you got that top end, and then you got the big sell-off in what should have been a bull market become a bear market for a couple of reasons. One of the biggest was Russia decided to only sell natural gas in rubles. So the dollar denomination of the natural gas really changed fundamentally. And really, this spike here was all dependent upon, or it came to pass due to the fact that the idea that the Russia supply was going to come offline to the world sent prices absolutely on a madman freight train north. So something like this, you can look at that is incredibly important in this area right here. You see, we're still very bearish. One area, though, I do want to highlight for gas traders, right there. That's a gap. That's an opening year gap from December 2022 to January 2023. That gap, it represents a price point that was not traded in natural gas. Now, typically gaps get filled, gaps get filled, gaps get filled. That's the idea. A lot of stock traders trade gaps only because they get gaps seemingly every day. We don't get those in the commodity markets very often. There's a gap there. So the idea is that eventually we're going to retrace and we're going to have an opportunity potentially to trade that gap and fill it in. If in fact that's the case, 447 somewhere in there is a topside target, and I would bet that it's probably a topside target for many institutions. Remember, we're going into the fall months. We're already pricing wintertime gas seasonality. That means that means that you're going to have more bids hit the market because of that increased demand over the wintertime. Remember, Northern Hemisphere drives your commodity markets, at least your energy commodity markets. And in the Northern Hemisphere, the summer months are big for WTI crude oil. They're bullish. And the winter months are bullish for natural gas. Why? Because more folks are going to use gas to heat their homes, their businesses, yada, yada, yada. In any case, I do want to point out one last thing on natural gas, and it's important. Don't forget your trend lines. Monthly trend line. Also have a monthly Bollinger Band there. That's probably going to be significant resistance. So let's go ahead and dial that down right there. Do the best you can. Remember, with a trend line, you got to connect 2 points. Where are you at right here? Nailing that trend line right around what? 29.10, somewhere in there. That's key. That's key. So if we do break above that area and we go up to 3, I would be looking for staunch resistance in this zone. But once we break that, and it looks to me like we're going to break that, maybe not this month, but next month, once that trend line's gone, I would love to see it go in October. Then we could really play this for a big rally, a big break like we did in the Canadian dollar. Keep a close eye on that trend line. That's big time. You gotta be aware of these things. Remember, trend lines, don't make them hard. Don't make them any more difficult than you have to. You don't need to get too advanced with these things. Just remember, you need to connect 2 or more points. Right there, we had 2 monthly highs that we connected successfully, and you can dial them in exactly if you want. You just use your coordinate play, but right there, sort of hit that and retrace. So I'm looking for a bullish breakout, probably in October for natural gas, and that trend line is really acting as topside resistance. That's the big enchilada in the natural gas market right now. So watching it closely, that area between 2.9 to 3, absolutely huge, absolutely huge. All right, guys, I'm going to go ahead and we'll cover one more market here, and we'll cover a U.S. index just because, why not? Let's go to the U.S. 30. All-time highs. That's the biggest thing we need to realize here. Monthly chart. It's the biggest bull market that we've seen in modern history. From the lows of March 2020 all the way up through this giant bull run. It's one of the biggest equities bull runs in history. It really is. Well, we went from a low of down there at about 18.2 to a high of 41 or 42. That's, you're doubling your value in just a couple of years. You don't really see that in stocks really ever. But a lot of fortuitous traders bought the lows of this Dow, played an index, and did very, very well doing it. Well, this action right in here is incredibly bullish. We had that big sell-off that sort of developed early August when the yen carry trade went belly up, and then we started really worrying about interest rates and stress on the financial system and all that jazz. What I would recommend here is just go right down. If you're trading this Dow, you go right down to your daily and see what's going on. Very obvious, not hard. Bullish trend, spike low there. Boom, we're getting a bit of a sell-off today. What would this sell-off be for? Could be for anything. Personally, I think we're just wiped out the previous day's low. That's the first time that symmetry's been broken since our Fed meeting, and you're starting to see stocks really fill in what I would call your post-Fed range. So I would be looking. If you want to trade it, you can bid it. You can scalp it at 41,781, or you can scalp it from 41,635. In this instance, I think that your best entry point for the US 30 or the Dow 30 is going to be right down there at 78%. Now, I'm not above scalping 62%. I think you could step up and scalp 62% as well. But if, in fact, you come off big, 78%, 41,635, that's a big zone, but I've also got a daily moving average. My 13-day EMA is right there at 41,639 as well. So I would say that area, but from 35 probably up to 50-ish, something like that, is a premium long entry, and it will be for the next day or two, probably the rest of this week. If you wanted to scalp from right up here, right up above 62%, you certainly could. That could be significant downside support as well. All right, everybody, I want to thank you for joining me today. It's sort of been an interesting session. Commodities are one of my favorite things to trade. We just covered metals and energies today, but realistically, things like wheat, things like soybeans, things like live cattle, things like lean hogs, they're all pretty good trading mechanisms. You just got to figure out how to play them, what angle you want, and exactly how you're going to approach the market. Because remember, trading soybeans, trading wheat, it's a lot different than trading, say, a gold or a crude oil. Why? Because each one of them has a unique set of market drivers that are integral parts of how each market moves. Right now we're seeing stocks tank. Could be a good day to buy that Dow 30 from 41,780, 41.8. Not bad area. Maybe we'll check that one out later in the day. All right. It doesn't look like my live chat functioned again on the YouTube or whatever. It says it's waiting for new messages, but did not receive any. I genuinely don't know what's going on there, so don't be offended. If you sent me a bunch of messages and I didn't answer, always happy to. You could always cruise by the How to Trade trading room and send me a private message, and I will get back to you directly. All right, everybody. Thanks for watching. Trade the action well, and we'll talk soon. See you.